Mondher, for quite some time we are in a low or even negative interest rate environment. How can investors still generate some income with corporate bonds?
Good morning, Claude. That's a very good question, actually. I think the interest rate environment is going to stay quite low for a very, very long time. And at the beginning of the year, we even said forever. The crisis we have been through doesn't help, of course, because governments are taking on much more debt with all the fiscal packages. And to service that debt, really low interest rates will help. So interest rates will be with us for a very long time, if not forever. That's absolutely the statement we can make. Now, where to find value in the bond market? Actually, corporate bonds are extremely attractive, be it Euro corporate bonds or global corporate bonds, of course. We have a slide, and basically it shows a little bit the spread movement that we have experienced during COVID-19, and the spreads have corrected, too much, of course, but that's helpful in a sense because we are going to have below zero or even zero interest rates everywhere for quite a long time. So with corporate spreads, as you can see, at the moment, one can easily achieve about 300 basis points. So that's a decent value. So, to basically achieve good income in the bond market, I would say corporate bonds are the alternative that is extremely attractive at the moment. And more specifically, developed market corporate bonds. And they offer very attractive value at the moment. And hopefully for some time to come, we say corporate bonds is really the safe, risky asset class that we have on offer for now.
Now, as you mentioned already, economies are slowly coming back now that the lockdown is over. How will this recovery in corporate bonds look like?
I think the economy is coming back after an extreme shock. That's definitely the case. We're already starting to see green shoots. Typically, when really you step back and you look at what happened, and when you look at data going back even to the 1950s, when we have an extreme shock, usually the recoveries bounce back quite quickly. And people talk about U-shaped and V-shaped and things like that. We think it's going to be much more like V-shaped in the end than anything else because we had an extreme shock, and because when you have an extreme shock, it has been that way, in the past. So how can the corporate bonds behave from now on? This is a very interesting slide as well. It shows basically an index, and in this case we have basically the Euro corporate bond index, but it would be the same for the global corporate bond index. We always recover quite strongly after experiencing a shock. As we can see from the slide, in late 90s we had a shock with the telecom bubble, we had negative returns. We bounced back quite strongly in 2000. With the 2008 crisis, we were in a similar situation, a little bit worse than basically in the late 1990s. Negative returns in 2008, of course, but very strong comeback again in 2009. Now, year to date in corporates, we're around minus 3%. It's an extreme shock. The spreads have widened 5 standard deviation. Then after that, we expect things to come back to revert to the mean somehow. So from now on and next year, we should have extremely good performance in the developed market corporate bond markets.
And how attractive are these valuations right now?
Very attractive, as we repeat slide 1. Euro corporate bond spreads have moved 5 standard deviation. It's the same for global corporate bond spread. And then this is reverting. We expect the recovery to continue, not only because of technical reasons, but also for fundamental reasons, which we will go into a little bit later in the interview. So very good valuations relative to the expected credit fundamentals of corporates. Really, this is a bond picker's market. There is tremendous value. We still have very depressed valuations for very good and strong corporates, very wide spreads. So the valuations are extremely attractive. There's plenty of opportunities in many sectors, for example, in financials, especially sub-financials, in corporate hybrids. They have basically widened too much. And finally, certain sectors, for example, the real estate sector has been hit quite a lot. So we see extremely good valuations there and so on. So quite a lot of valuations, and as you can see, the spread's quite attractive.
This is very interesting. So what do investors have to keep in mind when looking at corporate bonds?
This is the key. I think people tend to be a little bit too negative, right? Why is that? When we went into that crisis, we thought, looking at the Chinese experience and their experience of COVID-19, and then the beginning in Italy and how it's been handled, we thought that this issue, in the end, it does make sense after the Chinese experience that this situation is contained and eased over a period of 3 months, right? That's what we thought. And it seems to be that way, because now we're opening up, as you said early on. So what we did and followed through various means of research, we decided, okay, we came across certain research pieces that basically highlighted the fact what we should be looking at is perhaps erasing 1/4 of cash flow, for instance. Since this is going to be contained for a period of 3 months, you take a corporate, you erase 1/4 of cash flow, and then you look at the corporate without, basically 12 months of cash flow, but 9, you subtract 3. And how do they look like in terms of leverage, and how can they mitigate basically this absence of cash flow or this gap of cash flow? So first of all, when we looked at the leverage does not go up that much, just a little bit. Of course, it goes up a little bit, in 2020 from perhaps 2.6 times to about 3 times. But then in 2021, the leverage should come back down because basically EBITDA comes back. So in the end, the deterioration of investment grade developed market corporates is going to be light and temporary, because this is a shock for a defined period of time. The leverage, yes, goes up a little bit from 2.6 to 3, but should come back down to about 2.8 in 2021. So one can see that the leverage picture goes up, but not massively, just a little bit. But this is a little bit of a worst case scenario, because at the end of the day, the corporates, as highlighted by this chart, this is basically the line, is the cumulative cash flow generation of corporates for 1/4. It's about 400 billion in the US, US corporates. So US corporates generate on average on a quarterly basis 400 billion. And what this chart shows really, even if you don't generate this, the corporates can really mitigate the issue by doing the following. And they have been doing, and they have been taking some of these measures. For example, not paying dividends. We see that dividends represents quite a bit of cash flow. Doing less acquisitions, right? So acquisitions is in yellow. It represents a little bit of cash flow. Buybacks are quite important. Maybe companies should take a holiday from buybacks, and so on. So there is a lot of possibilities to mitigate this absence or gap of cash flow. And in the end, if companies are diligent, they will be able to mitigate this issue. And actually, leverage might not even go up 2-3 times. So let's see what the corporates do. I think people tend to be a little bit too negative. Because of that, the valuations have really widened quite a bit. But when one does really a little bit of simulation and looks at cash flow generation and how this absence of cash flow generation can be mitigated, actually the impact is going to be much more light than people believe.
Thank you very much for this fascinating outlook. Thank you for having here in the studio, Mondher.
Thank you, Claude.